Meta's 2025 report looks strong at first glance, but the real story is much deeper. Behind the growth numbers, there are signals most investors completely miss. So the real question is Meta still a smart investment today?
Today on the FinTalk channel, we're talking about Meta Platforms, INC.
Yes, we are.
And imagine a company that just prints over $60 billion a year in pure profit by selling digital ads.
Right.
And then they immediately turn around and set nearly a third of that cash on fire in a laboratory trying to invent, like, mind-reading glasses.
I mean, it sounds like the plot of a cyberpunk novel, honestly.
Exactly.
But it's literally just their 2025 annual report.
Yeah, it is. Welcome to the FinTalk channel, everyone. Our mission for this deep dive into Meta's 2025 Form 10K is to figure out the absolute reality of what is driving this company's multi-trillion-dollar valuation here in early 2026.
Because there's a lot going on under the hood.
Oh, absolutely. So whether you're building a personal portfolio, running an institutional fund, or, you just want to know why your Instagram feed is so bizarrely accurate lately.
Which is a valid question.
Right. This filing is essentially a roadmap. We are looking at this incredibly mature, dominant ad engine that is aggressively funding a multi-billion-dollar pivot into what they are legally referring to as superintelligence.
Yeah, and to really grasp the valuation, you kind of have to hold two contradicting ideas in your head at the same time.
Okay.
You have the ultimate cash-generating machine on one side,
Right.
and then you have this speculative hardware and AI laboratory operating at just a massive loss on the other side.
Yeah.
And we really can't understand the laboratory without first understanding the machine that's actually paying for it.
Okay, let's unpack this then. Let's start right there with the cash engine, what they call the family of apps.
Right, the core business.
Exactly. This is Facebook, Instagram, Messenger, WhatsApp. And the top line numbers for 2025 are, honestly, they're almost hard to conceptualize.
They really are.
Total revenue hit $200.97 billion.
Wow.
Yeah, that is a 22% increase from 2024. And net income alone was $60.45 billion.
Which basically means they are pulling in tens of billions in pure profit just from facilitating digital social interactions.
It's staggering.
It is. And if you look at the average revenue per person globally, it hit $57.03.
Wait, globally?
Globally.
Yeah.
Think about that scale. Across billions of users worldwide, including developing markets, they're extracting nearly $60 a head.
But the metric that really forces you to stop and reread the paragraph is the dynamic between ad volume and ad pricing.
Oh, yeah, the supply and demand quirk.
Right. According to the filing, the total ad impressions delivered, meaning the sheer number of times an ad was shoved in front of a user, went up by 12%.
Okay.
But simultaneously, the average price per ad increased by 9%.
Yeah.
And from an economic standpoint, I mean, that shouldn't happen. If you flood a mature market with 12% more inventory, the price per unit is supposed to drop, or at least flatten out.
What's fascinating here is that you're touching on the exact mechanism that makes modern Meta so dominant.
How so?
Well, the traditional way of thinking about advertising is like, buying billboard space on a highway.
Right, totally.
If you build 1,000 new billboards, the value of each individual billboard goes down because supply outstrips demand.
Makes sense.
But Meta's ad inventory isn't a static billboard. It's driven by artificial intelligence.
Okay.
The reason advertisers are willing to pay 9% more for ads, even as the volume of ads increases, is because the conversion rate is just going through the roof.
So it's less about buying a billboard and more like, I don't know, paying a hyper-efficient matchmaker.
That is a much better way to look at it. Usually, printing 1 million more flyers makes each flyer worth less.
Right.
But Meta's AI isn't printing generic flyers. It's creating these highly personalized, probabilistic invitations.
Interesting.
The machine learning models have become so extraordinarily adept at predicting consumer behavior that an advertiser isn't really paying for space anymore.
They're paying for results.
Exactly. They are essentially paying for guaranteed customer acquisitions. Online commerce was the massive driver here in 2025, particularly as they pushed more ads into lower monetizing spaces like Reels.
I do want to push back on that predictive power a little bit, though.
Sure.
Didn't Apple basically break Meta's tracking capabilities a few years ago with those iOS privacy changes?
They certainly tried to.
Yeah. And even in this 10K, Meta explicitly mentions their own internal tool, Your Activity Off Meta Technologies.
Right, the opt-out feature.
Exactly. It lets users block their data from being aggregated. So if the data pipelines are restricted by Apple and by users, how is the AI actually getting better?
It's super counterintuitive, but the data restrictions actually forced Meta to evolve a far superior system.
Really?
Yeah. In the old days, they relied on deterministic tracking, literally following a user's device
Right.
from an ad click directly to a checkout cart on some external website.
Right, the old pixel tracking.
Exactly.
Yeah.
But when Apple restricted that, Meta had to pivot to probabilistic machine learning. They started training massive AI models to predict what a user would do based on fragmented internal signals they actually do control.
Like what kind of signals?
Like how long you linger on a specific video, who you message, what time of day you scroll.
Oh, wow.
Yeah. They engineered their way around external limitations by making their internal predictive models infinitely smarter.
Which I imagine requires an unbelievable amount of computational power.
A ridiculous amount.
Which brings us perfectly to the expense side of the ledger. We see the $200 billion coming in. Let's look at the cash going out.
Let's do it.
Because maintaining that predictive edge is clearly not cheap. In
Right.
2025, 82% of their total costs and expenses, a staggering $96.29 billion, were allocated to that family of apps segment.
Yearly $100 billion.
Right. And the primary driver, data centers, technical infrastructure, and AI.
This is where we really transition from a software company to a massive, heavy industry operation.
Yeah, it sounds like it.
That $96 billion isn't just paying software engineers to sit and write code. It is concrete, steel, power grids, and cooling systems.
Wow.
For example, the 10K details this massive new 2025 arrangement to co-develop a data center campus in Louisiana.
Okay.
When we talk about training the next generation of artificial intelligence, we are talking about consuming the energy equivalent of small cities.
And the terminology they use in the SEC filing is fascinating to me.
Oh, the superintelligence stuff.
Yes.
Oh.
They explicitly outline their pursuit of superintelligence, which they define point blank as artificial intelligence that surpasses human intelligence.
Right there on the 10K.
Yeah, and they're integrating their Meta AI assistant across every app, web interface, and piece of hardware they make.
Everywhere.
But looking at this as an investor, I mean, pouring nearly $100 billion into infrastructure to chase superintelligence feels incredibly reckless.
It sounds a bit sci-fi.
It sounds like a pure science experiment, honestly. It's like Meta is building a massive multi-billion-dollar rocket without knowing the exact launch date or destination.
I can see why you'd say that.
So where is the immediate return on investment for the short-term shareholders? Doesn't this alienate them?
If we connect this to the bigger picture,
Yeah.
it looks like a science experiment until you realize that the infrastructure has a dual mandate.
A dual mandate.
Yes. The beauty of Meta's capital expenditure strategy is that the exact same computational infrastructure required to build future superintelligence is currently being used to rank the reels you watch tonight.
Oh, so the Louisiana data center isn't just like a sealed-off laboratory waiting for the year 2035.
Not at all.
It's actively figuring out which sneaker ad I'm most likely to click on this afternoon.
Precisely. They are funding their futuristic R&D by routing it through their current profit engine.
That is wild.
Meta views the pursuit of superintelligence as an existential necessity. Philosophically, Mark Zuckerberg's stated belief is that developing this technology openly will empower individuals in the future.
Right.
But financially, the calculation is much simpler.
Which,
The smarter the core AI becomes, the better the ad targeting gets, and the higher the toll they can charge advertisers today.
okay, I see.
The 22% revenue growth we just discussed, that is the immediate ROI of that infrastructure spend.
Okay, so they have the back-end brain running in places like Louisiana. But where does this superintelligence actually live in the physical world for you and me?
That is the big transition.
Right, and that shifts our focus to the Reality Labs segment, which is Meta's highly scrutinized quest to build the next consumer computing platform.
And this is where the numbers get rough.
The financials here are absolutely brutal. In 2025, Reality Labs generated $2.2 billion in revenue, which is up slightly by 3%,
Okay.
but it operated at a massive loss of $19.19 billion.
$19 billion in operating losses for a single corporate segment is almost unprecedented.
It's hard to fathom.
It is. And they are completely transparent that Reality Labs will continue to hemorrhage cash for the foreseeable future.
But the way they are spending that cash is fundamentally changing, which I thought was interesting.
Yeah, the mix is shifting.
The 10K notes that 70% of the 2026 Reality Labs budget is now strictly allocated to wearables,
Right.
with only 30% going toward virtual reality headsets and the Horizon digital environments.
They're clearly moving away from the bulky VR goggles and moving toward your face and your wrists.
Yeah, we've seen the Ray-Ban Meta glasses. We saw the Orion True AR prototype in 2024.
Yep.
And now they have the 2025 Meta Ray-Ban display, which puts a usable screen right into the lens.
Which is incredible tech.
It is. Here's where it gets really interesting, though. The piece of hardware that completely stopped me in my tracks reading this report is the new Meta Neural Band.
Ah, yes. The Neural Band is arguably the most vital piece of hardware in this entire 10K.
It's crazy.
It's a wrist-worn wearable that utilizes electromyography.
Right, electromyography. I have to admit, I didn't fully grasp how wild this was until I read the breakdown.
It's not standard tech.
No. This isn't tracking your eye movements or listening to your voice. Electromyography reads the literal neuromuscular signals, the electrical impulses firing from your brain, down your arm, to your fingers, before your hand even physically moves.
It intercepts the signal.
Yeah. They want us to control our AI glasses using imperceptible muscle twitches. We are moving from tapping glass screens to literal Jedi mind tricks using muscle signals.
It's a massive leap in human-computer interaction.
But let's be real for a second.
Okay.
The average person barely wants to wear a smartwatch right now. Are consumers actually ready to strap medical-grade neuromuscular sensors to their wrists so they can text without touching their phone?
It's a fair question.
I mean, is this just an incredibly expensive R&D vanity project?
It's not vanity, it is survival.
Survival.
Think back to our discussion about Apple restricting data tracking on iOS.
Okay.
For the last decade, Meta has been a wildly successful tenant, renting space on operating systems owned by Apple and Google. When the landlord changes the rules, the tenant loses billions. Meta's leadership recognized that to protect their long-term future, they cannot rely on a competitor's hardware.
They need to own the actual glass in front of the user's eyes.
And the interface the user touches.
I see.
That is the entire strategy. If augmented reality glasses replace the smartphone over the next 10 years, Meta wants to be the underlying operating system.
They don't want to be a tenant anymore.
Exactly. And the Neural Band solves the interface problem.
How so?
Well, you can't realistically tap a keyboard floating in thin air. It's awkward.
Yeah, you look ridiculous.
Right. So you need a seamless input method, like reading motor neurons. That $19.19 billion loss isn't a mistake.
It's deliberate.
It is an aggressive, incredibly expensive insurance policy to ensure they buy total platform independence for the next era of computing.
Escaping the Apple and Google duopoly is one thing, though. Escaping sovereign governments is an entirely different battle.
Oh boy, yes.
And that brings us to the global regulatory minefield detailed in the 10K.
It's a thick section of the report.
Very thick. Meta is trying to build a global, unified hardware and AI ecosystem, but they are constantly slamming into aggressive, localized regulators, systematically trying to rein them in.
It's constant.
And reading the sheer volume of legal threats here is dizzying. And just to set the ground rules for you listening, we are analyzing these regulations purely from a business mechanics standpoint.
Exactly. Completely neutrally.
Right. Without endorsing any political viewpoints, we just need to understand the board Meta is playing on. Analyzing their legal threats is like watching someone play 3D chess on 5 different boards where the rules change every turn. How can investors price this in?
This raises an important question about how we categorize these threats.
Okay.
You can essentially categorize the regulatory threats into 2 distinct buckets.
How are they?
Punitive fines, which they can afford,
Right.
and structural disruptions, which actively threaten the core business model.
Okay, let's start with the antitrust bucket then. In the U.S., Meta actually caught a major break.
They did.
In November 2025, they won a victory against the FTC's long-standing lawsuit that aimed to break up Instagram and WhatsApp.
Yep.
Now, the FTC is appealing it as of January 2026, but the initial victory stands.
Right.
Over in Europe, however, the EU slapped them with a €798 million fine in late 2024, claiming they tied Facebook Marketplace to the main platform and breached competition rules.
Now, see, that €798 million fine falls into the first bucket.
The fines they can afford.
Exactly. It
Yeah.
makes headlines. But when your net income is $60 billion, you just write the check and move on.
Cost of doing business.
Precisely. The structural disruptions are the ones investors really need to pay attention to.
Right. Which brings us to the Digital Markets Act, the DMA, in Europe.
This is a big one.
In April 2025, the EU fined Meta €200 million over their subscription for no ads model.
Yep.
And that forced Meta to launch a less personalized ads tier for European users.
Which is a huge structural change.
Let's dig into the mechanics of that. Why does a less personalized ad tier actually matter to the balance sheet?
Well, think back to the hyper-efficient matchmaker analogy from earlier.
Okay, where they use AI to guarantee conversions.
Right. The only reason advertisers pay premium prices is because Meta's AI uses massive amounts of behavioral data to guarantee the ad reaches the perfect target.
Makes sense.
The DMA forces Meta to offer an option where ads are served based solely on immediate localized context.
Like whatever you were looking at right this exact second.
Exactly. Rather than your deep historical behavioral profile.
Wow.
And when you strip the AI of that historical data, the conversion rate plummets.
So it becomes a generic billboard again.
Exactly. And if European advertisers see lower conversion rates, they will refuse to pay that 9% premium we saw in 2025.
So the DMA is actively degrading the core product they sell.
Yes.
And it gets more complicated with data sovereignty. The 10K highlights the ongoing saga with the Irish Data Protection Commission.
The IDPC, yeah.
They hit Meta with a €1.2 billion fine. But more importantly, they ordered them to suspend transferring user data from Europe to the United States.
Which is a massive headache.
Now, that is currently paused by the Irish High Court, but the threat is active.
Yeah.
If they actually block transatlantic data flows, doesn't that break the global AI infrastructure we just talked about?
Absolutely it does. The machine learning models in Louisiana rely on a global data set to identify patterns and predict behavior.
Right.
If Europe effectively builds a digital border wall and says, our citizens' data cannot leave this continent to be processed in your American servers,
Then what happens?
Meta has to physically duplicate their infrastructure.
Oh, man.
They have to build entirely separate, localized AI models just for Europe.
That sounds horribly inefficient.
It degrades the overall intelligence of the global system and massively inflates their capital expenditures.
We aren't even touching the localized youth protections yet.
Those are popping up everywhere.
Yeah, Australia passed a strict ban requiring social media companies to ensure users under 16 cannot hold accounts. And various U.S. states are passing fragmented laws requiring parental consent. From an engineering perspective, how do you even comply with that?
It creates an absolute nightmare of compliance engineering.
I can imagine.
Meta has to build age verification architecture that somehow works differently in Texas than it does in California, and entirely differently in Sydney.
It's so fragmented.
It requires dedicating thousands of highly paid engineers just to build regional regulatory patches, rather than building the superintelligence or the AR wearables.
So the real risk of regulation isn't the fines?
No, it's the sheer friction it adds to their innovation pipeline.
It's like trying to run a marathon while someone is legally requiring you to stop and change your shoes every mile.
That's a great way to put it.
But, beyond these external regulators, there is a fascinating internal vulnerability detailed in the report.
Oh, the violating accounts metric.
Yes. This goes directly to the integrity of the data Meta presents to the public and to its advertisers.
It's a crucial section.
Let's look at it. In the fourth quarter of 2025, Meta states they updated their methodology for estimating accounts that violate their terms.
Right, so we're talking about bots, spam networks, inauthentic behavior.
Exactly.
And with this new methodology, which relies on enhanced detection signals, they now estimate that just under 5% of their worldwide daily active people consists solely of violating accounts.
So what does this all mean? Because I have to pause on that number.
It's a big number.
Nearly 5%. When your user base is measured in the billions, 5% is an astronomical figure.
Well, absolutely.
If I am an advertiser paying top dollar for these AI-driven conversions and I find out 5% of the audience are basically digital mannequins,
Yeah.
isn't that a massive vulnerability for advertiser trust? It's like finding out 5% of the audience at a sold-out stadium are actually mannequins.
It is entirely rational to see that number and balk.
Why should anyone trust the metrics if the platform is admitting that millions of daily users aren't even human?
Well, you have to view this through the lens of encryption and scale.
Okay, explain that.
The 10K explicitly points out that as Meta pushes end-to-end encryption across platforms like WhatsApp, they deliberately blind themselves to the content of the messages.
Right, for privacy.
Exactly. So they can't read the chat to see if it's spam. They can only analyze metadata, like the frequency of the messages.
Oh, I see.
At their scale, tracking a unique human identity across platforms without requiring linked accounts is inherently flawed.
But the number went up in late 2025.
It did.
That sounds like they're losing the war against the bots.
Actually, I would encourage some critical thinking here. The fact that the number went up after they updated their methodology is arguably a positive signal for investors.
Really? How so?
Think of it this way. The bots were always there. Meta didn't suddenly leave the gates open and let a flood of new fake accounts into the system.
Okay.
They finally just bought better binoculars.
Ah. So the stadium isn't suddenly filling up with mannequins.
No.
They just finally upgraded their cameras to distinguish the mannequins from the real fans.
Exactly. When you implement better detection signals, your error rate discovery is naturally going to spike.
Ah, that actually makes a lot of sense.
By being transparent about that 5%, they're actually cleaning the data set.
Because they can filter it out now.
Right. And for an advertiser, knowing exactly where the noise is makes the remaining human signal much more reliable.
Got it.
The AI models we talked about in Section 1 require clean data to make accurate predictions. So removing those newly discovered bots improves the efficiency of the entire ad engine.
It really highlights the sheer complexity of operating at a planetary scale. Every time they pull a lever to improve privacy, like encryption, it breaks a different lever, like bot detection.
It's a constant balancing act.
So to synthesize everything we've unpacked from this massive 10K today,
Let's hear it.
Meta is currently operating an incredibly lucrative, highly mature digital advertising monopoly that uses predictive AI to essentially print $60 billion in net income.
An unstoppable cash cow.
Yeah. But instead of resting on those laurels, they are taking that mountain of cash and pouring it into Louisiana data centers to build artificial superintelligence.
Yep.
And they are funding $19 billion hardware losses to invent electromyography wristbands.
Sci-fi level stuff.
All while simultaneously playing a brutal game of defense against European data regulators and global youth protection laws on every continent.
It is a company in the middle of a profound metamorphosis.
Truly.
And I would leave you, the listener, with this thought to consider on your own.
Okay.
We still call Meta a social media company.
Right, out of habit.
But as they transition from a software app that tracks what you click on a glass screen to a wearable company that reads the neuromuscular signals directly out of your wrist,
Yeah,
the definition of a social media company is fundamentally changing.
absolutely.
By the year 2030, will we look back and realize we missed the exact moment Meta stopped being an advertising platform and fundamentally became the base operating system for human interaction?
Wow. That is the trillion-dollar question, isn't it?
It really is.
Because if they pull off this pivot, the balance sheet we just reviewed won't just be a blueprint for a profitable tech company anymore.
No, it won't.
It will be the blueprint for how we physically interface with the digital world. Thank you for joining us on the FinTalk channel for this deep dive into Meta's 2025 reality. Keep asking the hard questions, and we'll keep exploring what's really hidden inside the filings.